back. You're watching India Market Open. The markets are struggling to hold on to the gains that we saw yesterday, but 22,100 is where we are at, 16 points on the index, but off the day's high point on many of those broader market names. Well, the big focus and talking point on the street and across every dinner table right now is elections and what that means for you as an investor. Trideep Bhattacharya, CIO-Equities Edelwiess AMC, joins in to help us understand that. Trideep, there is so much to talk about, right? I mean, I think every conversation, be it a coffee, be it a dinner table, or be it a TV channel, is elections. And that seems to be the sole focus of investors as well. Somewhere along the line, I think the focus has moved away from the India story to the election story. How important and critical do you think the election performance is, or the outcome on 4th of June is on the markets at this stage? Do you think it's much ado about nothing?
First of all, good morning and thanks for having me on your show. I would say that overall, in the context of investing in the way it should be done, which is over the medium term with an outlook of 3 to 5 years, the election outcome is basically a small flash in the pan. Doesn't really kind of alter too many big things as long as there is not a regime change. And I'll come to that in a minute. What matters is where the situation is. And the fact of the matter is that if you look at the capacity utilization of India as a factory, India Inc. is closer to about 78%, which means that we are awfully close to a full capacity and there is a good chance of capex cycle. And likewise, there are multiple data points. If you look at, for example, power sector, there is a shortage which is which is there in the country, which is irrespective of who comes in power. So net-net, there are certain parts or the high-frequency data points are pointing you in one direction, which has got less to do with who is in power than otherwise. But from a near-term standpoint, I would not undermine the outcome as well. I would say that if we get a hung parliament, or a regime change, that's the time that we should be worried, or as we get close to that, if we do get close to that. Otherwise, if it is just the size of the majority, which seems to be the debate in most of the channels and most of the places that I look at, then it's, I think, interesting dinner time debate. But from a stock market standpoint, from policy change standpoint, things don't change all that much.
I agree with you. From an investor standpoint, it should not impact you. All it's doing is impacting traders because option premiums are so much more expensive. But let's put this in perspective. You've got a setup where earnings have not been extremely impressive, to say the least. FIs have been selling from April after the change in the Mauritian treaty to now, of course, election volatility. And from what I understand, they'd rather buy at a premium than buy ahead of an event. And that's what has happened historically, not just for our markets, but globally as well. In a situation like that, and their portfolios have also made money. Let's not forget the last few years have been phenomenal for an investor. Would you now say the good thing to do is, or the right thing to do is, to take some profits off the table, let your capital go, or pull out the capital, do a little bit of a cash call, consolidate, and re-enter this market post the event? Is that a fair way to do it, or do you feel like staying 100% invested is worth the risk and worth the chance?
I think overall it depends on the kind of gains that individual has made and the circumstances that they're in. So I wouldn't get into a prescriptive debate on that. But what I would certainly say that, I mean, this is certainly a buy on dips market rather than sell on rally market, in my opinion, from a 3 to 5 year perspective. I think whosoever comes in power, the underlying earnings resilience from a medium-term standpoint of Indian corporates is there to kind of watch out for. As a sector, an example, I would point out real estate to you. If you look at India's real estate market today, the housing unsold inventory is basically at 12-year low. Now, while this is happening in India, if you look at other parts of the world, whether it is China or United States, the data points point to a far more grimmer picture with regards to real estate. So, very specific data point with regards to India, but it shows in terms of pockets of earnings resilience, India has certainly been one. Now, one has to put this earnings resilience in context. So when we came out of COVID, we had 2 weak years of growth. We had 2 strong years of growth. FY25 would be a normalized year of growth. So yes, growth would be lower than what we have seen in last year, but that in the context of where we are headed in terms of earnings growth, would still be about 15 to 17%, which in the context of last 20 years of India would be called as fairly resilient and well distributed across sectors. So net-net, I'm saying that don't undermine the earnings resilience of India Inc. as yet. Second, some pockets within the country are very country specific, very bottom up, and that needs to be taken into cognizance. And keeping all this in mind, yes, of course, we've had a phenomenal rally, but occasionally we do see volatility. Use that volatility to increase the position rather than sell on rally and stay in cash. This would be the stance that I would probably think about when I'm talking to investors.
Hi Trideep, morning. Tamanna here, and I just want to come back to the voter turnout detail, because this is such a bugbear for the market, or possibly in the absence of any other talking point, it's just become interesting to talk about it. I just want to quickly refer to this Bernstein note, which I found quite with a different take, which says that if you want to compare voter turnouts compared to 2014, not 2019, because 2019 had a pro-incumbency, national security kind of an issue post Balakot, etc. That was a different election. Their take is compared to 2014, because 2014 was similar in the sense you'd had a government which had finished 10 years in power, and then the voter had to decide whether to continue or not to continue, change or keep. So, I mean, that's the theory they have. Now, my question to you is, looking at the phase 4 numbers, where voter turnout is actually barely 1.5% lower than 2019, the revised election commission figures also show barely 2.5% gap between phases 2019 to 2024. Do you think that this now calms the market? And what the ground reports are from the next few phases will continue to be at least a short-term trigger till the 4th of June.
Yeah, I think you summarized it quite well. But let me give my take from an investor standpoint. And here is what I think about overall. The first thing that we need to understand is translating this turnout share to vote share. I think one needs to keep in mind, and earlier the jitteriness in the markets was that if people don't come out to vote, one party's vote get disproportionately impacted than that of others. That may not necessarily be true. And now that the data has come out that the voter count is not that different, vote share count is not that different, or the turnout share is not that different, overall the outcome is kind of, and that certainly calmed the nerves. But I think, just to put things in context, ultimately, if we get the incumbent government with a total share count anywhere between, let's say, 300 to 350, I think that's a number which broadly markets would be fine with. If we get a combined share count north of 350, I think the market will probably cheer. And the closer it gets to 400, the better it is that the incumbent party did better, and hence things would react in a particular way. The problem area really starts if the combined head count of the incumbent government turns out to be less than 300. So the reason I put those numbers out is not that I am an expert on elections, but just in the context of where expectations are and how do we think about it in a very simplistic manner. The closer we get, or the lower we get to 300 is where the problem really area starts. Otherwise, it's more of a discussion point. So I agree with you that so far initially the nervousness in the market has calmed to a certain extent because the turnout share is not that different. But I wanted to link it to the share, the vote share, and the overall numbers for your viewers to kind of make their own judgment. Hope that helps.
So then it comes down to the core question, Trideep. How are you playing the next sort of 2 weeks till the 4th of June? Everyone who's watching this right now wants to know what Trideep Bhattacharya thinks and what is he going to do till the 4th of June in a volatile market. I mean, and there are two sides to it. One side is that, just buy, don't lose this opportunity because you're going to be sitting on the 4th of June and wondering why you missed the bus, or be careful, stay on the sidelines. Which way are you swinging on that debate?
Yeah. So I think, as I said earlier, that overall, when VIX was down to about 10, broadly about a month or so ago, we raised a bit of cash. overall, but it's a small amount, and so we have a bit of dry powder with us. And we are actually taking advantage of the nervousness in the market to actually place our bets in those areas where we think earnings are likely to be resilient. Again, while election is a matter of debate in all the boardrooms and everywhere for the next month, what is a matter of debate ad infinitum is basically where earnings, in those areas where earnings are likely to come versus earnings that are not likely to come or beat the estimates. So, in other words, whenever there is nervousness in the market from here till June 4th or first fortnight of June, we are taking advantage of where of this weakness to buy into or increase our exposure to those areas where we think earnings are likely to be resilient over the next year or two.
Very quickly, Trideep, because let's leave our viewers with a takeaway at the end of our conversation. Defense looking good to you, railways looking good to you. You're already seeing a GE shipping, Cochin shipyard, all of those perking up. So for the next couple of weeks, what are the areas that you would sort of be positive on?
5 areas that I would point you to. One is broadly the capex as a theme. I think any weakness, any different one should take advantage of. Power as a theme, the different parts of the supply chain of power, whether it is transmission, distribution, or for that matter, generation, could be an area to look into. Real estate, both direct and indirect plays, would be another area where we would look for weakness to capitalize on it. NBFCs could be the fourth one, where we are interested in particularly areas which are AAA rated, which will do well over a period of time. And finally, defense. Given that, given our Atmanirbhar Bharat theme will probably continue over a period of time, I think the company's order book for the next 20 years are full. So a little bit of a flutter doesn't really make too much of a difference. So these would be the 5 areas where any weakness is a good opportunity to buy because earnings are likely to be resilient over the next couple of years, in my opinion.
Thank you, Trideep. That was superb. Specific, clear top 5, focus points for Trideep ahead of June 4th. Thank you. Always a pleasure to speak with you. Hope to talk to you soon once we have a clearer picture on what's happening. And that will possibly be June 3rd. All right, time for a short break. On the